It was a tough day on the stock market with the PPI number coming in hotter than expected this morning. So all of a sudden, inflation is a concern once again, whereas it seemed like we were coasting higher with the bulls for much of this year. Today was actually the second worst sell-off day that we've had so far in 2023. And we did have most companies lower as a result. Only 15% of stocks closed in the green here today. Most of the mega cap tech companies that control the market's prospects were down, and in some cases quite significantly. So we'll take a look at all of that and see what it means for the postures of our overall indices. We'll have a little bit of a macro conversation in addition to some sector analysis. We'll also take a look at the factor selector in tonight's video, and then we'll get into our trade application example where I wanted to take advantage of a stock that has been very much in the news here lately, and not for good reasons, where their stock has started to sell off more aggressively, and wonder to ourselves, is this an opportunity to sell a put with higher volatility where we can try to lock down that stock that has a long track record of dividend raises at a much more attractive price lower in the future. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 16th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. And also at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that group you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And my, oh my, what an ugly session it was. It's been a while since we've had something like this. It's been one of the bigger sell-off days that we've had in 2023. Obviously, we're only about 46 days into the year here, but nonetheless, it was a little bit jolting, I suppose, for some, depending upon whether they have forgotten the pain that came with 2022. The truth is, of course, most people, of course, were in the markets last year, and so they shouldn't have forgotten about it completely. Nonetheless, we have had some pretty good go of things here on the bullish side of the equation so far this year, and I, for one, am not surprised to see us give back some of that. In fact, even after today's sell-off, I remain in the camp that feels like we've had it probably better than we deserve so far this year. And I think, of course, things can change in a hurry, so we've always got to keep our eye on the ball there. But today was certainly one that you will put in the bearish camp. A lot of it driven by a hotter than expected PPI number, where there are inflationary concerns that are still persisting out there, which are leading to market participants feeling like the Federal Reserve is more likely than not to continue on with their rate hike campaign as we move forward. So let's take a look at what happened here on an individual stock basis with the heat map, and you can see there's not a whole lot of green on the map, just a few here and there, and usually just one-off stories. Of course, a couple of dividend stocks that catch my eye. Cisco is a stock that we've bought a number of times in my DGI classes over time. They did have a nice little 5% increase today based upon their earnings announcement yesterday afternoon. In addition to that, some of you saw me posting on Twitter that Cisco also increased their dividend. However, like I mentioned in my Q&A class today, I must admit it was a little bit underwhelming from my perspective, as it was only up about 3%. And I think they can do a little bit better than that, so maybe they're just playing it safe here this year. Nonetheless, good to see them at least raising the dividend. I also see that Comcast was up today, another stock that we've bought a number of times in recent years, especially recently here in the last year or so, is really when its stock price has come down and therefore become attractive to dividend investors now that they have a yield that's right around that 3% territory. For many years, Comcast had a yield that was 2% or less, but it's only really in the last year or so that the stock price has come down aggressively enough where it's actually become a legitimate dividend growth stock all of a sudden. So it's nice to see that one up a little bit here today. I see that Home Depot was up just a touch today. AT&T was up just a touch. speaking of dividend stocks, here's West Pharmaceuticals. This was actually the best performing stock in the S&P 500 today, with Cisco being number 2. West Pharma is actually a dividend aristocrat. You guys rarely hear me talk about it because unfortunately, it has very little in the way of actual dividend yield. Remember, when a company becomes a dividend aristocrat, it does not require them to have a substantial dividend yield. It merely requires them to have a long history of raising the dividend payment itself. And so if the stock's price goes up much more rapidly than the dividends are being raised throughout the years, the yield itself can stay under wraps. In other words, not really grow to attractive levels. So anyway, that's one that we don't talk about a whole lot. Nonetheless, is an aristocrat. It was up 14% today. That was a heck of a move out of that stock. Speaking of aristocrats, in this case, at least we did buy this one once upon a time in my dividend classes. This is Albemarle. This is another dividend aristocrat. This one is a lithium mining company. Remember, there's not a whole lot of materials companies that have long histories of growing their dividends, but this happens to be one of them, and of course has really caught fire here in the last couple of years in a good way because of course, of Tesla and other electric vehicle companies out there requiring a lot of lithium for the batteries that they're producing. In fact, since we bought Albemarle in my dividend class, I think it was, I don't know if it was I think December of 2019, if my memory serves me correctly. But anyway, we're up quadruple since that time, which of course is not an easy thing to find out there in the dividend aristocrat world. Usually they move pretty slowly, but we happened upon one in this case that absolutely roared higher. All you have to do is pull up a 10-year chart on ALB and you'll see what I mean in that case. That stock was the third best performing stock in the S&P 500 today, up nearly 5%. But otherwise, as you can see, pretty hit and miss. A little bit more green in maybe the healthcare area here. So although it didn't overwhelm all the red in healthcare, at least there's multiple instances of green showing up in healthcare. But really, it's hard to find anything positive to take away from the heat map here today. As you can see, the vast majority is in the red, and in some cases, dramatically in the red, right? Take a look at Tesla finally giving back some here today, down about 5.5%. Remember, Tesla has been on such an incredible run this year that it literally doubled so far on a year-to-date basis from high to low. So now giving some of that back, but nonetheless, it's been an extraordinary thing to witness for sure. NVIDIA, of course, has been a topic du jour lately with ChatGPT and everything else going on. It was down 3% today. Remember, it was those two I talked about specifically on Tuesday's video as kind of carrying the whole market. I was saying at that time that don't let the end results of the market fool you. It was actually a much more bearish day than what most people assumed, because that was the day where the stock market was basically flat. The S&P 500 was down like 0.03% that day. Yet when we looked at the heat map like we do during my sessions here, we noticed that most companies were down, and those that were carrying the market, at least from a larger cap perspective, were NVIDIA and Tesla. And then when we went and looked at the market breadth numbers, we saw just how bad it was. Only a third of the stocks were up and 2/3 of them were down, yet the market was flat. So those two companies that carried the whole market on their back on Tuesday fell flat on their face today, and now they're not there to save the market. The market was down significantly today. It was not flat, and most of the stocks, as you can see, were also down. So from a market cap weighted perspective, you didn't really have much in the way of heroes today. Apple was down 1%. Microsoft was down 2.6%. Alphabet was down over 1%. Amazon was down about 3%. I already mentioned Tesla down over 5%. Even Walmart and JP Morgan and UNH and Berkshire and ExxonMobil, all of them down significantly. The biggest companies that were up today were relatively afterthought types of companies like Cisco and Comcast. I hate to say it that way because they're both, $100 billion companies. But in this land of the giants that we find ourselves in right now, where we have companies that are worth $2 trillion, then even companies that are $100 billion don't really have a big impact on the market unless they've got the support of the bigger companies that are out there. So all in all, it was a pretty ugly day, and definitely scored this one in the column of the bears. Let's go ahead and take a look here at our heat, or not our heat map, but our breadth measures. Over here on the Thinkorswim platform, I've got the Market Watch visualize area pulled up, and then I've got the S&P 500 public watch list, so that way we can get a gauge of whether it's just a handful of companies that are leading the way, like was the case on Tuesday, or whether it's a whole army marching alongside the commanders or the captains. And today was one of those days where the entire army was retreating. The bears were clearly winning the war, and the bulls were retreating back to their barracks. And so you can see here only 74 stocks out of the S&P 500 managed to close higher here today. That's only 15%, which means that 85% of the stocks in the market today closed in the red. So it was not some sort of an anomaly that you saw with the end result. It was a deserved result for the most part, considering the participation with the vast majority of companies to the downside. Let's go ahead and now come on over here to the charts. And as often the case, if we ever have a day that's up or down more than 1%, I like to start our charting conversation here on chart 6D, and that allows us to see this middle portion of the chart that kind of shows us volatility in a slightly different visual format. You'll notice that there's this black horizontal line that kind of goes through the middle. That is our zero line. So if there's ever a day where the market is flat, it will basically be right on that line. In fact, that's a good reminder, because I just said on Tuesday when I was with you last, it was a flat market performance. And right there, I'm circling right where Tuesday's day is, and most of you can't even see that. That's how flat it is. If I were to zoom in, of course, it'd be maybe a little bit easier. But right there is Tuesday, and it almost looks like it's empty because there was basically no performance on Tuesday. Thanks to NVIDIA and Tesla. But today, that is certainly not the case. Today you can see a very clear pattern to the downside here. And as you can see, this is the biggest red candle that we've had in probably at least a month. Let me kind of zoom back out a little bit here. The last time we had a day that was this bad was right here on the 18th of January. So not quite a month, but almost a month to the day. So those two have been the worst days that we have suffered so far here in 2023. Because even this day and this day were better than what we experienced today. And the cutoff right here is where the crossover occurred. So basically, if I were to zoom in, that area that we are now seeing right now is the calendar year 2023. And so again, today, second worst day of the year that we've had so far. The other thing that I'd like to point out is what I've been mentioning in other classes or presentations as well, is that in terms of the bigger movements in the market so far this year, notice that we have way more green bars that are stretching higher to a fairly large degree compared to the red bars that are stretching lower. And that's the exact opposite of what we experienced last year. Last year, we went through lots and lots of periods of time where we had tremendous red candles to the downside and very few green ones to the upside. So this has been a more stable market experience that we've all witnessed so far in 2023. But, you know, things can change, so we'll keep our eye on it. But so far, even though today felt like an awful day, if taken in context of what we received so far from the market this year, it's actually been a blessing thus far. Notice that the VIX did rise here today, but even that, we ended just a little bit above 20 on the VIX. Remember, in the old days, if you were at 20 on the VIX, that would have been considered low. And so it's kind of interesting that I'm saying, hey, we rose all the way up to 20 here today, when of course that's usually on the low end of the scale. So that just goes to show you how things have calmed down tremendously in the market. For those of you that are newer, oftentimes we'll refer to the VIX as the fear gauge or the fear index. And typically it is inversely correlated to the market at large. When the market is up, the VIX goes down, and when the market is down, the VIX goes up. So that inverse correlation held true today with the market down, VIX went up, but because it's down so significantly, even though it went up today, it is still considered historically low here at 20. So anyway, we'll see if maybe there can be a little bit more fear that gets stoked into the marketplace. But right now, it's just kind of a mess scenario. And so we shall see. I do know that the market has continued to sell off a little bit after hours. If I pull up SPY here, you can see that the bid on SPY currently is 407.23 and the ask is 407.27. So just a little bit above 407 right now, which basically means that the SPY is down another dollar after hours. So not a huge deal, right? Today's normal session, it was down almost $6, but just saying that, hey, we didn't really see any sort of benefit where bulls came into the market in the after hours session. If anything, the bears have just continued a little bit more aggressively in the after hours session. And so tomorrow morning, all else being equal, what we see right now is we should probably assume that we'll have a little bit of a sell-off. And remember, that can help bail out some of your trades. Some of you that are premium members, at least, saw me close down one of our trades for this market outlook category that had really been, struggling for me, for lack of a better term, because the markets have been bullish. And of course, I've done more bearish trades during this options expiration period than bullish ones. Looking back, I probably wish I hadn't, but nonetheless, as we are standing right now, one day before expiration, all of those trades are basically working out for me. Remember, I did shut down the SGML trade a week and a half ago, and I took a very small win on that. It was only like a $5 win, but hey, a win is a win. Nonetheless, that one is off of our books, and I'm glad that I did that because since then, that stock has bounced back a little bit. And then the one I did today where I shut it down, I think was on Intuit. And that one had been in a negative territory for me as well in terms of profits and losses. In other words, I wanted it to go down and it had been going up. Well, today was a day when Intuit was down tremendously. And so that helped my bearish trade on it. You can see it was down 3% here today, or $12 per share. And so I was able to close that one down at a very nice win. So it's been interesting because for much of this options expiration period of when I've been placing trades for this market outlook video, I felt somewhat uncomfortable with my bearish deltas that I've had. And then all of a sudden here in just the last couple of days, it kind of feels like I've been bailed out with most of my trades. And now all of my trades have been profitable. And remember, that's not something we take for granted. For the most part, you should assume that you're going to have plenty of losing trades as a trader. And I've had my fair share of them, to be certain. But at this exact moment in time, all of our trades are going swimmingly. And unless something dramatic happens tomorrow, it looks like we're going to be batting with a very, very strong batting average when we go to shut down our wins and our losses for the month of February. And again, I was not necessarily assuming that just a couple of weeks ago because the markets were so strong. So for those of you that have been kind of layering in some of these bearish trades here over the last couple of weeks or months, I think a day like today is actually somewhat beneficial in order to kind of right the scales there a little bit. So we'll see what March brings, but right now it appears that we're kind of drifting into the February expiration close with a little bit more bearishness than maybe some people had assumed. Let's go ahead and now come on over to our foregrid, and that is chart 4B. And with our foregrid, a reminder that the background colors over today's candle will tell us whether we have a bullish or a bearish posture. And remember when I was with you on Tuesday, we had gone to a weekly bearish posture on all four of our charts. And I thought that was a little bit peculiar because it's not like the markets have been doing terribly, but maybe that was a heads up. Maybe that was the heads up we needed that, hey, now all of a sudden we are going to get a little bit more selling pressure, a little bit more bearishness here. And maybe it was a heads up of what was in store for us here today with getting those signals on Tuesday. The problem is, as you can see, after I gave you my presentation on Tuesday where we got these little thin pink areas of the chart over Tuesday's candle, you can see that most of them went back to a green background on yesterday's candle because yesterday was a pretty strong day in the market for most of these indices. So we've kind of had some back and forth here lately. And the way it stands right now is, even though the S&P 500 is currently lower than where it was on Tuesday when we initially went to a weekly bearish posture, so far we haven't fallen into that trap again. We're awfully close. Remember, in order for this background color to turn light pink again, in this particular case, the green line would have to fall out of the upper reversal zone. So on Tuesday, it did so just ever so gently. It went down to 79.84. Remember, it only has to go below 80, so it was about as close as you can get. And then with yesterday's bounce, no surprise, the green line went up into the upper reversal zone again. But notice where we're at right now on the green line on the market, or on the market forecast technical indicator for the S&P 500. It shows that we're at 81.35. So we could easily drop out of that upper reversal zone as soon as tomorrow if we get more selling pressure tomorrow. But for right now, we do still have that strongly bullish posture that we gained back yesterday. And in addition to that, notice that we have what's known as a bullish intermediate confirmation signal here on the S&P 500 as well. In fact, this one, from a blue line perspective, looks a little bit better. However, it's still not of that ideal category. And the reason is that the red line is too far down below. I know it seems like we're kind of getting nitpicky with that type of thing, but in general, we prefer this red line to go into the lower reversal zone, but reside somewhere between 20 and 5. That's a healthy pullback, but not a damaging type of a pullback. Sometimes what we've noticed, when the red line goes to what we refer to as extremes, in other words, 5 or below, then that means that this is a more serious and jolting and violent action that could very well drag the whole market down with it. We don't know that to be a fact, but that's the thought process. That's what we're curious about, right? And right now you can see that the red line, the momentum line on the S&P 500 is at 1.31. Remember, it does not go below 0. So that just goes to show you how low that is. And clearly that's below 5. And so, yes, it's true. We do have a bullish intermediate confirmation signal today on the S&P 500. But one of the limiting factors of that signal is just knowing that the red line is in an extreme level right now. And we might want to take it a little bit more seriously that it was such a strong sell-off here today. And sometimes that can lead to even further sell-off days. So we'll keep our eyes on it, but just be aware the signal does officially exist. Speaking of which, down below here on the NASDAQ composite, you'll notice we also have that signal where the green line is considered bullish because in this case it's in the upper reversal zone. And down below, you'll see that the red momentum line is in the lower reversal zone. So that constitutes a bullish intermediate confirmation signal. But again, it's not of the ideal variety. And in this case, it's got two things wrong with it, which is the blue line, unlike up here with the S&P 500, where it was between 50 and 20, notice that the blue line in this case is at 65. So it's not below 50. And therefore, it's a sign that there hasn't been a healthy enough of a pullback. And then with the red line, it's at one of those extreme readings as well, similar to the S&P 500, where it's 0.7. So you kind of have conflicting signals internally there that don't necessarily make this the ideal setup out there, even though the signal technically does exist for both the S&P 500 and the NASDAQ composite. Most of you have been with David and I for the last 10 or so years when we've been doing these videos, both here at Market Scholars and then earlier at TD Ameritrade. So you're probably familiar with that term, bullish intermediate confirmation signal. But for those of you who are not familiar with it, let's say you just stumbled across this video tonight while surfing YouTube, basically it is referred to as a buy the dips signal. So what the philosophy of the signal is, with the green line still in bullish territory, that means that the intermediate trend is still intact. But at the same time, this red line, which is much more sensitive, has a fairly violent sell-off in the midst of an intermediate uptrend. So in other words, you want to ride the trend, and if you kind of establish new positions within the trend, then you might as well do it when stocks are cheap. And it's when the red line goes into the lower reversal zone, when prices they tend to be lower than where they were the day or two before that. So that's kind of the general idea, but naturally there's a lot of wiggle room on how you interpret that out there as well. And so that's where the art portion of evaluation of technical analysis comes in and helps you along a little bit more than the science. Let's take a look here at what the NASDAQ did today. It was down about 1.78% here today. And so it was our worst performing major index. And remember, that's typically the case. When we have a violent day to the downside, oftentimes it is the NASDAQ and or the Russell 2000 that underperform because they're oftentimes viewed as a little bit more speculative. Today, the Russell actually beat the S&P 500, but the NASDAQ was clearly worse than the S&P 500. So each day is a little bit different in that regard, and some of it just depends upon what are the themes of any particular day. And today was a day where technology didn't seem to be working particularly well, so that had a bigger impact on the NASDAQ. In terms of the other two charts now, the Dow Jones up here in the upper right, it was down 1.26% today. But you can see that the chart all of a sudden looks worse than the others. Now notice that this one would not be considered a bullish intermediate confirmation signal because the green line is no longer bullish. Notice that the green line at 78 and falling has now fallen out of the upper reversal zone and is going lower. If this was 78 and rising, that would be a different story. Because then it would be qualifying as the line was going up. But right now it's falling, and that's not really doing it any favors. Notice that the Dow Jones is the only index that has the green line falling right now. You can read that in the labels there. So over here on the S&P 500, it's rising. On the NASDAQ Composite, it's rising. And on the Russell 2000, it's rising. So the Dow is the only one that has a falling green line at the moment. And since it's falling and not above 80, then we would consider that to be weakly bearish. Remember, like I mentioned to you on Tuesday, think of this as like the storm clouds are starting to gather, but the storm isn't here yet, and we don't know if the storm will get here. Sometimes the storm clouds blow out of the system. In fact, I was just texting with my older brother here a second ago. He's an NBA fan, and he was saying, boy, it looks like you guys have some beautiful weather there in Salt Lake. He's down in Austin. And I said, yeah, it's been kind of nice because usually this time of year we get a lot of smog here, believe it or not. I know a lot of people kind of laugh when they think Salt Lake City and smog. It's because of the geographic distinctions that we have here where we kind of sit within a bowl and we have these things called inversions that come in the winter, and it makes our air just really ugly and yucky to breathe and everything like that. So anyway, we must have had some winds here overnight and blew that smog out of our system, and now our city looks glistening and beautiful and picturesque just in time for the NBA All-Star game this weekend. So if you're watching that, I'm sure you'll see some good pictures of Salt Lake there with the mountains in the background and all that kind of stuff. But the same thing happens in the markets, right? The storm clouds will appear. Sometimes that will lead to a horrible snowstorm, or if you're in the summertime, just a nasty downpour of rain and thunder and lightning and all that kind of stuff. And other times the wind will just kick it out of the system and you wouldn't have known otherwise, right? And it's a perfect day the next day. So right now, when we have this kind of light pink background color here, that is kind of the idea of having storm clouds out there, even though there is no storm that is present at the moment. It's just a possibility that a storm could show up. It's the first sign of that possibility, right? Usually storms don't come out of the blue with no advanced warning. This is one of the advanced warnings. It's just that not every advanced warning actually leads to an actual storm. And that's where, that type of thing tends to frustrate people. But, that's the nature of a highly variable financial marketplace like all of us have to deal with here in the stock market. So we have to do our best with whatever information is present at any given moment in time. So we have the storm clouds that are here on the Dow, and what I would say is that the storm clouds have gotten a little bit more serious this time around, and the reason I say that is because you'll notice that on the Dow we are now trading below that rising moving average, right? We had the storm clouds here, we had the storm clouds back here as well, but what makes today a little bit different than right here and right here is that we are currently closing below the moving average. We didn't just touch it, we closed below it today, right? And so it's telling us that there is a little bit more of a concern here all of a sudden on the Dow Jones Industrial Average. But the good news is, as you can see from the other three charts, that is not the case with the others. So it's a question of whether is the Dow going to drag the entire rest of the market down with it, or are these other three charts going to be supportive of bullish price activity and kind of pull the Dow Jones Industrial Average back up off the ground, right? So we'll keep our eyes on any clues for that as the days move along, but just be aware that we do have a weekly bearish posture on the Dow, and it's a little bit more serious today than it was on Tuesday because today we closed below that 30-day moving average. And then down below here on the Russell 2000, it was down 0.96%, so it actually did better than the Dow's loss of 1.26% today. That doesn't always happen, but today it happened to work out for the small caps. So it was our best performing index on a relative basis today, but still obviously has a little bit more of a bearish tilt towards it. You don't want to be down 1% on a day, especially after yesterday was such a nice day for the Russell, right? That was actually starting to show some improvements there, like it wanted to get up and off the mat and start bouncing higher again. So it's unfortunate that rally had to fizzle a little bit today, but as you can see, we do still continue to have that strongly bullish posture. So maybe today was just a quick little head fake, and maybe tomorrow we're back to the races again, right, to the upside. So we shall see. But notice that the Russell 2000 is different than the other three because the red line did not end in the lower reversal zone here today. So there wasn't nearly as much selling pressure on the Russell 2000 today, and it didn't even close near its lows. Notice that you can actually make out visually the lower shadow on the candle here today on the Russell 2000, whereas you can't really see the lower shadow on the candle on the NASDAQ, on the S&P 500, or on the Dow Jones Industrial Average, because for those, they basically closed at or very near the lows of the day. You can't make that same claim for the Russell 2000. It was off the lows quite easily here today. So it seems like there continues to be a bit of strength there in the Russell 2000, and it's going to take a little bit more effort if the bears want to take control of that chart from the bulls. All right, let's go ahead and step on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. And so when I did the video on Valentine's Day, you guys stepped up to the plate with 114 of you click and like, and I'm glad to see that, if anything for my wife, right? Because of course, as most of you are aware, when I'm doing these videos, half the time I don't even get a chance to eat dinner with my family on Tuesdays and Thursdays because I'm doing these free videos for you guys. So it is nice that you guys can help support them, knowing that, yes, this does cause an interruption in our family lives and our personal lives and everything just to do this free video for you guys. But of course, we like to do it, and it's a way for us to get the name out. And like I said last time, hopefully it's a situation where we can support each other. We continue to educate you with free videos. You continue to support us by clicking like on Twitter and hopefully getting that information out to a wider audience than we would be able to otherwise. So thank you so kindly to all of you that help support it, including Ken and John and Brandon and Sandeep and Rick and Robert and C Trader and Arth and Adrian and Stock Market Junkie and Roger and New Low Observer, John Bollinger. We've got Anoop and Dennis and Caitlin and Beatrice and Kirk and Camilla and Roger and Dave and so many others. Can't get to all of you, but I do like to get some shout outs out there to those of you that take the 5 seconds out of your day to click like for us there. Also, on that topic, today in my question and answer session, as most of you are aware, that I have on Thursday mornings, I work with my premium members, and most of the questions that I receive are about trading strategies, trade management, what we're doing with our class portfolios, et cetera, et cetera. Today we got a question about Twitter, as a matter of fact, and it was a question about how can I look at Twitter and only see what you and David Settle are posting on Twitter, because the background of the question was this person has followed a lot of people, and when they go to their timeline, they see all kinds of tweets coming in, and they can never find the tweets from David and I that they want to see. And so I showed them in today's video how to set up a list on Twitter. Some of you might not be familiar with that process, but if you come over here to the More area, if you don't see it initially, there's this thing called lists here. And what that allows you to do is create a list of certain people that you want to follow specifically on Twitter. And when you click into that list, you will only see their tweets and nobody else's. And so that would make it nice and easy for you guys to be able to go in there and actually just click like on these market outlook videos or what have you. Now, remember, David and I try to make it easy for you guys to find these anyway. You'll notice that on my normal timeline, this is pinned to the top of my timeline, right? Twitter allows you that ability to pin one single tweet at the top. So what David and I do when we post these market outlook videos is we will unpin the prior tweet associated with the prior video and then pin the newest tweet there. So every couple of days, you'll see that my pinned tweet has changed to whatever my most recent market outlook video is. So we do try to make it easy for you regardless, but if you do have an interest in understanding how to set up a list on Twitter and you're a premium member of Market Scholars, feel free to watch my recording for my Q&A class today that is now posted into the class calendar. And by the way, we set that list up on my on our Market Outlook corporate Twitter account. And so just as a heads up, I'll drag that into view. This is our corporate account. And if you guys actually go and look at our list here on the Market Scholars Twitter account, there'll be like a little, I think, 3-dot icon or something like that when you come over to the Market Scholars account. If you click on that 3-dot icon and then go to lists, you'll see the one that I created here in our class earlier today, and you guys can join that list because it's a public list. And so that way, that list is now part of your list, and you would be able to actually go in and just hone in only on David and I's tweets if you wanted to. Obviously, you guys can all use Twitter however you decide it's best for you, but since I got that question today and it was somewhat topical, I figured I'd mention it here in case you guys had never heard of that idea or that concept before, and maybe it will be helpful for some of you as well. So it was a good day there with the question and answer sessions for my class, and then I think David taught his portfolio management with ETFs class, and then tomorrow we'll be doing his technical analysis class. So lots of great stuff here for our premium members. Also, while we're over here, let's go ahead and take a look at the factor selector and see what the latest update to that tool is. Remember, I usually do the factor selector on Tuesday night, and then I post it on Wednesday morning, okay? And so one of the things that you'll mention is, or one of the things that you'll notice is that when I mention it here in these Thursday YouTube videos, that it will be somewhat delayed, but for those of you that are premium members, you can always access the most recent one on our website where it's a little bit more timely. So let's take a look at the upper half of the graphic here, and we did have some new information to be aware of. Notice here that quality is up there at number 1, and low volatility is down there at number 6, or the bottom. And both of those are new from the prior week, and that hasn't happened a whole lot. But this is one of those weeks where we've had a little bit more choppiness and ability for the different themes within the market to start changing a little bit. And so, like I mentioned to my students in class yesterday morning in my factor-based swing trading class, from my perspective, quality has had a nice little push higher here recently because there is a high allocation of technology stocks within the quality factor as a result of both Apple and Microsoft carrying basically the best credit ratings of all of the companies out there, right alongside of Johnson & Johnson, of course. And so since a lot of the tech companies these days have such healthy balance sheets, they are one of the biggest components within the quality factor ETF. So from my perspective, because technology has been strong recently, that has now allowed quality to be strong all of the sudden. On the downside, you can see low volatility replaced momentum at the bottom. And from my perspective, that's likely because as of Tuesday night when I did this graphic, again, things changed today, but that would not be included here. But as of Tuesday night, we had a market that was very much interested in taking risk. And, the market was not so interested in, the defensive areas of the market, right? Those are the boring areas that are left behind when everybody is chasing, the next exciting thing out there, whether it's Carvana or what have you, right? Those types types of stocks that got kicked in the teeth last year have been the superstars this year. So who needs a boring old utility company if you can chase a 100% return out of a Carvana, right? That's kind of the mindset of the market right now. And so low volatility, as the name suggests, is made up of companies that do not move around on the charts all that much. And typically the lowest volatility stocks are the ones that come from the quietest business models out there. Oftentimes you're looking at utilities and REITs and consumer staples and big pharma healthcare companies. And so those are the exact areas that did reasonably well last year. Notice that low volatility, if we were to backtrack with it, you can see back here at the beginning of December of last year, it was actually number one. So it went from number one all the way to dead last during a time when the markets changed its stripes pretty dramatically. And we saw a lot of chasing of kind of junkier companies come into fashion once again and leaving all of the consistent old school business models in the dust. So that's kind of where we find ourselves right now. And it has been interesting, to say the least, to see some of these movements a little bit more aggressively as a result of the pretty aggressive jolt that the market has received since the end of December. All right, let's get back on track now with some of our charting analysis. And we're going to come on over here and take a look at our asset class 12 grid here. And so a reminder that on this chart 5A, you will see here that we have quite the mix of green and pink charts at the moment. And remember, that's typically the case. This is not meant to be all green or all red at any given moment in time, because this is such a wide variety of different asset classes that we're tracking here. So let's go ahead and get started with the lower corners, as has been the case for much of the last year. In the lower right-hand corner, we have the 10-year Treasury yield, and it was up yet again. Remember, we were talking about that on Tuesday, how it had that bullish engulfing candle, and I was saying, boy, all of a sudden, you turn around and the interest rate environment feels a little bit higher once again, right? For a while, we were kind of in this downslide in interest rates, but that didn't take very long to see interest rates shoot up pretty aggressively here in just the last 2 weeks. All of a sudden, the 10-year Treasury yield is at 3.84% right now. So it's not quite to the 4% territory that we were experiencing a bit there last year, but we're well off the 3.5% readings that we had just a couple of weeks ago. So remember, in general, that's probably not the greatest thing for the stock market. So far, it hasn't really derailed the stock market, which I've actually found to be impressive, that the stock market has been as resilient as it has been in the face of this pretty aggressive push higher in interest rates here. Remember, all else being equal, higher interest rates are typically bad for the stock market because it cuts into profit margins most of the time, right? If you have higher interest financing charges as an organization, there's less money left over for profits to be distributed to shareholders in the form of dividends and stock buybacks and things like that. So, some of these businesses in the United States that have been gorging on corporate debt for years and years and years once it was low, they might realize that they're going to have a hard time weeding themselves off of that. And so they're going to have to constantly refinance their debt, and then they're going to unfortunately find out that when it comes to refinance, that the rates are going to be higher than where it might have been when they took it on initially, and therefore their interest charges that they're going to have to be responsible for are going to be a lot higher as well. So, all that kind of works its way into the stock market and makes people less enthusiastic or interested in stocks, knowing that their profit margins could very well end up being squeezed as a result of higher interest charges. So right now, market hasn't really seemed that concerned about it. But who knows if that changes or not? We saw it awfully aggressively change last year when that was the case, and so far it's been just a little bit of a head scratcher why it hasn't necessarily had the same effect so far. Maybe the market doesn't believe it. Maybe the market's thinking it's a bluff. I don't know. But all I know is the S&P 500 remains above its rising moving average right now, despite Treasury yields making a big run for it to the upside. Of course, on a day when Treasury yields are up, remember the opposite happens to Treasury bond prices. They are inversely correlated, and over here you can see on TLT, we've had a pretty ugly spillover here on TLT, and I don't really hear a lot of people talking about it. Of course, there's always somebody talking about it, but it's just not like a big theme. Like if you turn on CNBC, you're probably going to hear more people talking about Chat GPT right now than you're hearing about people talking about how the long-term U.S. Treasury bond is rolling over aggressively as we speak. You'll notice that it's been such a vicious sell-off there for TLT, you now have a red moving average again. In other words, price is below a falling moving average, and that has not been the case since last year. This was December 30th right here, and that was the only other time on this 3-month chart where you had a red moving average up until today. So it's really saying something here that this has been a fairly aggressive sell-off here to the point where it's basically bending that moving average lower now, and that had not been the case earlier in the year. It was down 1.42% today. Foreign bonds were also down. They were down 0.21%, and then high yield bonds were down 0.8% today. You'll notice that both of them, of course, have that shared characteristic with TLT of a strongly bearish posture with those red background colors, but foreign bonds do not yet have a red moving average. However, high yield bonds do, and it's the same thing as with TLT. Today is the day where we've had enough selling pressure from this overbought cluster signal. So remember, sometimes those work out pretty nicely. It nailed it to the day on HYG in this case with that red dot above there. That was the perfect day to be selling out of HYG and letting the sellers have their way with the chart for a while. So ever since that topping out day there with the overbought cluster signal, we've basically just gone straight down. And all of a sudden, we find ourselves on high yield bonds basically back to where we were when we started the year. So we gave back all those gains in really just the last 2 weeks. And then today, as I mentioned before, we now have a red moving average with price below a falling moving average in this case. Notice that gold did not show any improvement either. Similar to high yield bonds, we had a cluster that effectively started this sell-off. However, this one was not as clear cut. With HYG, that was the only red dot on the board. With gold, there were plenty of these red dots that didn't really live up to expectations until finally the last one did. So a little bit of a different story there. Nonetheless, as I mentioned on Tuesday, my attitude towards gold has changed quite dramatically here in recent weeks. Whereas I was once a staunch bull on gold earlier this year, it has now given way to more skepticism once again because gold has not acted well here for the last 2 weeks. It's acted as though it is completely comfortable being below the moving average. And now you can see that the moving average is red as well as of yesterday. So we didn't know that on Tuesday when I was with you, but we now know it here today that that's one more feather in the cap of the bears in gold right now. Things are not looking so rosy there all of a sudden. But who knows? Maybe we'll get to a point where it gets to, oversold cluster signals, and then we can have the conversation about whether it can rally back to the upside or not. But right now, we're just jumping the gun a little bit with that conversation. So things don't look particularly good in the gold market right now. Oil was down just a touch here today. It was down 0.83%, but you can see its background color remains dark green, telling us that we do still have a strongly bullish posture on on oil, unlike what we saw with gold where we have strongly bearish posture. And here you can see that we're basically sitting right on the 30-day moving average for oil. So I'm not particularly enthusiastic about this chart. I'm just saying my mind remains open and flexible with this chart. In other words, I could see it break in either way, and we just don't have enough evidence to suggest one way or another yet. It could, who knows? It's driven by geopolitical news quite a bit as well, so that plays a role. But, when you're basically sitting exactly in the middle of the high-low range over the last 3 months, and you're sitting right on the 30-day moving average, you just don't know, and the market doesn't know, and that's effectively what those metrics mean. Otherwise, if the market did have an idea, it would have already sent it to wherever it's planning on going. So right now, the whole market's trying to figure out where does oil belong at this moment, and it's a bit of a question mark. U.S. dollar. In the lower left-hand corner here, you can see was up a little bit today. Not a huge surprise there. Remember that the U.S. dollar can be perceived as a safety asset of sorts, kind of like I've mentioned in prior videos in the past. It's kind of like the cleanest dirty shirt in the laundry, right? Currencies across the globe obviously are a pretty ugly place in general because politicians have the ability to dilute them tremendously. But the US dollar is oftentimes perceived, at least, whether it's true or not, but it's at least perceived as one of the safer currencies out there. So it actually got the benefit of that safety here today and actually bounced a little bit. You'll notice that the US dollar still easily above that rising moving average, right? We talked about how it was resilient above the falling moving average here last week. Well, now we're talking about how it's above the rising moving average and how much of a difference this chart looks like right now compared to the entire 3 months prior to this chart where it was clearly in a downtrend. So this does seem like it has the makings of a legitimate reversal here, a trend reversal from a downtrend to potentially into an uptrend. And remember, that's the exact opposite of gold. Since gold is priced in US dollars, when the dollar goes up, gold more easily goes down, and when the dollar goes down, gold more easily goes up. So we could be looking at two trend changes right here, dollar changing from a downtrend into an uptrend, and gold changing from an uptrend into a downtrend. We did have something peculiar here in the form of Bitcoin today. Bitcoin was up about 4%, and it didn't quite get up there to 24,000, but it ended the day just under it. And that's actually one of the better closing prices for Bitcoin so far in this young year of 2023. Remember, normally on a day like this last year, when the markets were getting sold off aggressively, or at least somewhat aggressively, Bitcoin was right there in that risk-off mindset getting sold off as well. So the fact that it was up today is somewhat impressive. You know, maybe there is some value there. Of course, a lot of people talking about Charlie Munger and his comments about Bitcoin yesterday. Some of you saw my quotes of Charlie on Twitter yesterday. He had some pretty good ones, as he always does during his interviews and what have you. But as most people are aware, Charlie likes to rail against cryptocurrencies and Bitcoin in particular. So despite Charlie's railing, Bitcoin is still quite firm and actually quite bullish at this exact moment in time. Up above here, you'll see that the foreign markets kind of had mixed results here today. Both of them outperformed the U.S. market. EFA was down, but it was only down 0.49%. EEM actually managed to close up today. It was up 0.02, so close to flat, but nonetheless, the fact that the U.S. markets were down over 1% and emerging markets were flat, that's a good bit of outperformance on a one-day basis. But I do wonder if part of the reason for that is they've already taken their lumps, right? We've been talking about how EEM has been selling off more sharply here in the last 2 weeks compared to other indices that are out there. So I wonder if part of today's story was just simply, they've already taken their shellacking and these other indices really haven't. So the others got to sell off a little bit to kind of play catch up to EEM, or in this case catch down, and maybe EEM can actually find some stabilization and try to catch a bounce higher before these other indices as a result of that as well. Let's take a look at our sectors now. And on the U.S. sectors 12 grid right here, you will see that we've got a pink chart up at the top, and that's communications, and then we've got a pink chart in the lower right, and that is real estate, but both of them are what we'd refer to as weakly bearish. In other words, those are your storm clouds. Again, we don't know that there's an actual storm. We just know that some of those clouds have slipped into view here. With both of those charts, they're actually at reasonable places, at least to my eye, because as you look at the moving averages, they remain green. In other words, it wouldn't be surprising at all to catch a bounce right around these vicinities for these charts. That can change, but right now you got to give it the benefit of the doubt. If the average price over the last 30 days has been going up, then oftentimes trending markets have a tendency to find bounces before those key levels are breached. So we'll keep our eye on it, but right now I'm not necessarily counting them out, so to speak. On the flip side, notice that down here in the bottom rung, with healthcare, staples, and utilities, all three of those have red moving averages telling us prices below a falling moving average. So there, the path of least resistance continues to be to the downside. However, there's been enough of a bounce here in recent sessions that apparently the color shift over to light green tells us that there is weakly bullish posture. But again, that's not strongly bullish. It's just saying that the conditions are starting to improve slowly. And we don't know if it's going to get into a rip-roaring bullish mode yet, but at least it's kind of stopped the bleeding to a degree. Whereas our stronger charts listed in the green, you can see are some of the more cyclical and growth-oriented areas. Technology had been quite robust, as had consumer discretionary. Today, of course, they both fell. Discretionary was down 2% today, 2.18% to be exact. And again, Remember, Tesla was one of the worst stocks in the market today, so that's probably the big story there. And then technology was down 1.74% today, and it was our second worst performing sector. And NVIDIA was a big component within technology. And remember, on Tuesday, we talked about the exact two same companies, but we were saying how it really benefited those two individual sectors. And now we're saying the exact opposite 2 days later. So it's kind of interesting to see how aggressively those two companies in particular are trading here just this week alone. But those were our two worst sectors here today, discretionary and technology, kind of reversing some of those themes that we've seen so far in 2023. But remember, one day does not make a trend. So just because we had a jolt here today doesn't necessarily mean that this is the end of the move for those areas. It just means that, hey, there's been finally enough people that have stepped up and said, you know what, I'm willing to take some profits here after a very good run in many of those types of companies. In terms of who the best performing sector was today, it probably would have been consumer staples. Yeah, it was. Consumer staples was down just 0.72% today. So not a huge move either up or down for it. And so it was, let's call it, the best performing of the losing sectors that are out there. So let's now get into our trade application example. And as most of you are aware, when we have a big sell-off day of 1% or more, just like I mentioned to you on Tuesday, so this should come as no surprise at all, when we have these types of days, you should assume that when you hear from me that night, if it's a Tuesday or a Thursday, that I will likely be looking at a sold put candidate. And so that is no surprise what we'll be looking at here tonight. So let me go ahead and get a chart out. Let's go ahead and use chart 2A for this conversation. And I will warn you that tonight's choice may be quite controversial to some of you. So as always, many of you, in fact, most of you, I would assume, would pass on most of these trades that we offer up, right? It's only going to be interesting to a very small and select group of people. But the whole idea is to learn from the trades, whether you are interested in actually taking them or not. And so many of you are probably going to take a pass on this one. I'll just warn you in advance. But what I ended up doing as the official trade application example is selling a put on Norfolk Southern. Yes, it's Norfolk Southern, and you're thinking to yourself right now, hasn't that company been in the news here lately? And the answer is yes, and not for good reasons. They've had a couple of pretty ugly accidents, and of course we feel terrible for anybody who would have been personally involved in those accidents, and they're going to have a lot of explaining to do, that's for sure. But the markets are punishing them, and remember, that's the way the market should work. When you have train crashes and bad things that happen to your company, then the stock price should go down, and that's exactly what happened here today. This company's stock was down $3.50, and it's been a pretty ugly week or two that Norfolk Southern has had. But railroads are wonderful businesses. They have some of the best economic moats known to man. You can't just kind of create a brand new railroad company out of the blue. So the companies that exist today are likely the ones to continue to exist 10 years from now and 20 years from now, etc. And there's still a lot of positive benefits of shipping freight and other heavy stuff on trains as opposed to flying them around or trucking them around. And so, it's rare when you have sell-offs in the railroad companies. And oftentimes when you do, they become buying opportunities for those that are looking to look past just the next few weeks. And so in today's case, you can see Norfolk Southern is rolling over here on my dividend stair-step charts, but they did recently just raise that dividend from 124 to 135. And typically over the past decade, it has been an attractive proposition to buy this company when its dividend yield is 2.65% or higher. So that is plotted with this dividend stair-step line right here. So in other words, this stock that's currently priced at $230 would need to come down here to $203 to be able to claim that its current yield is 2.65% or above. At this moment, it's only at 2.35%. So it would have to drop $30 per share before we would find it attractive for long-term purposes. So these are the types of charts that I like to look for in order to do sold put trades on, because it's basically saying, hey, we're not going to buy the stock right now because it doesn't meet our rules as dividend growth investors. But if it were to continue to drop and fall into the blue zone, then we'd very much be interested in locking down that merchandise at the right price. And so in today's trade application, what I did is I sold the March 200 strike put, and we received $2.05 for it. Typically, I target that 1% of the strike price for the credit that we would receive. And for those of you that are newer to that trade idea, what it does is it puts me on the hook for my willingness to buy this stock at $200 per share. Now remember, each put contract covers 100 shares of stock, so there would be a reasonably big capital outlay. So again, it might not be right for many of you for a variety of reasons. You really truly would have to want to own this one at a lower price. You'd have to put up with the negative publicity around it right now, which could lead to more aggressive selling, and it's a fairly high price stock, so some of you might not want to put 100 shares of this in your account. So for many of you, this is probably a pass, but for those of you in the right situation, perhaps this is one that could be worth investigating. Again, railroad stocks rarely go on sale, and we might be on the cusp of witnessing one of them doing just that, largely because they deserve to as a result of some of the accidents that they've had. So you are taking a little bit of a leap of faith there, but if you've been watching, this company for a while and saying, boy, I'd like to lock that down if it could ever sell off for me, you can see that the last time it was in the blue zone was back here in March of 2020 during COVID, right? That was the COVID drop right there. Had you been reacting to that move and acting for the long term by buying this when everybody else was puking it up, you're happy about that decision here today. And so likewise, if we get another aggressive move into that blue zone here as a result of this, tragedy, then maybe it ends up being an opportunity for those thinking out several years and decades from right now. Okay, so that's what I had for you here tonight. As always, if you enjoyed the presentation, we ask one simple request out of you: click like for us on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be more than happy to give you another full-length video like this one has been with a trade application example. Otherwise, if you prefer the 15-minute version of the video, then don't click like. And if we're under 100 likes, then I'll just plan to stick with a slimmed down version of the video with no trade application example. So we'll let you guys decide on that. But regardless of what it is that you decide, I appreciate you checking out tonight's video. I hope you all have a great weekend. For those of you that are basketball fans, enjoy the All-Star game here in Salt Lake City over the weekend, and we'll catch up with all of you early next week. All right, take care, everybody. Bye-bye.